Hi, everyone. I'm right here. This is Shreen Purwal with the amazing Kevin with, he's my guy for mortgages. So I always ask him my mortgage question. So Kevin, I was just talking to you about the 5-year rates and geez, it's gone up a lot. Tell us more about the rates, what's going on. And you're the money guy. So what's happening right now?
Well, there's definitely an increase in funds. So the cost of mortgages has jumped substantially in the last 2 months. So now we're looking at, fixed rates that are much higher, still not comparatively to where they have been historically, but higher in the sense that they're not where we have had them for the last 5 or 6 years, and then definitely for the last 2 years. So a lot of people are looking at, instead of 5-year rates, they might be looking at the 4-year rates or 2-year rates, just to kind of get through the next period of time. Because the Bank of Canada has obviously moved up prime. The bond market has moved up, which is where the fixed rates are, and in anticipation of any potential other rate increases. And the overall kind of expectation is for a lot of people that have mortgages, maybe they have mortgages outstanding or they're looking at mortgages, is to kind of get through the next 12 to 18 months. And that's where maybe shorter term rates that we would not normally use are something that people are kind of taking advantage of and saying, okay, I'll take a 4-year at 4.25
Seeing
to get through.
they're waiting for
Pardon me?
to go down in 12 to 14 months?
Well, I mean, basically the way I kind of, what I always equate it to is, think of it as the high water mark, right? So there's a point at which the level of rates or the water is going to get to a point where it's hitting its peak. The Bank of Canada has a real kind of balancing act that if inflation was gone and if it wasn't here right now, they wouldn't have probably done their last rate increase of 1%. It would have been more slow and sustained, because right now a lot of people are feeling it, whether they are in variable mortgages or they have mortgages that are coming up for renewal. And they bought in 2017, 2018 when rates were between 2.5% and 3.5%. So now they're coming into a rate environment of 4%. 5%, high fives for the 5 years. So
a month ago, I was looking at 2%. Now I'm looking at 4%.
Yes, correct. And so that's kind of where we're at. So, so this is the goal of the Bank of Canada is obviously right now is inflation, get back down. But then after that's done, maybe they'll come back down as far as readjusting where prime is at and settling prime, closer to 4%. So that people aren't, because there's a lot of big mortgages out there, and what they don't want to have is they don't want to start seeing defaults, right? And that's probably the other part that they're looking at, right? So
defaults start
yeah,
increasing, then they start cooling things down a bit to make it more affordable again.
right, yeah. So it's really like I said, just trying to get through the next period of time. So some people are okay with a variable rate; they're comfortable with whatever rate increases happen. We don't change our payments. Royal Bank doesn't use that. We use what we call a triggering rate. So for people that have had variable mortgages, even though there's been a series of increases, their rate hasn't changed. Their payment hasn't changed. However, their rate has. So the amortization would have adjusted. And those ones, we just suggest you make additional payments yourself, but we're not requiring that. There is a point at which you will have to make additional payments, or the system will automatically adjust. But for the short term, if somebody's rate was, prime minus 0.8 and their amortization was 25 years, when the rates had moved up, now their amortization might be 29 years, but their payments are still the same. And that's where the triggering rate starts to come in. There's a rate that's a calculation which is different for everybody, that will come in and we'll have to adjust their payment up, right? So we don't change it each time. There are some lenders that do that each time, and will adjust accordingly and make your payments go up.
So speaking of default rates, how are the default rates right now? Are they increasing, decreasing? What are you seeing with payment delinquencies?
Well, we haven't really seen anything like that because, again, everything's very short term. And so usually when you see increases in rates or changes in the economy, there's a kind of a little bit of a drag as far as lag time between when they're going to get it. So, I mean, if somebody's looking at having issues, with their payments or whatever, then that's going to be probably something that could be 6 months down the road, a year down the road, because they can probably get through savings and things like that potentially. Or they might put their house up for sale. A lot of people do still have equity, even though, as long as they didn't buy within the last year, they bought 4 or 5 years ago, with the majority of the increases that have happened, the fall of the market is roughly, they said 20% is what they're kind of saying on average. Well, 20% is still pretty high considering that, say, 2017, it went up 20 to 30%. So you're still up. You're just not up as much as you were, right? So some people are maybe selling and taking that equity that they had prior to the recent decrease and just, getting out because they can't afford the payments, or they're not prepared to kind of tough it out as far as, like, they just can't seem to make it work.
Okay, so that's good information. So the next thing I want to get into is I deal with a lot of some non-resident buyers, self-employed income, employed income, and they always ask me about down payment. What are those questions that you get? So I need you to do a quick overview, and we just have 5 minutes. Sorry to put you under the gun there, but just a quick view of these types of people and what they need to qualify.
Well, with non-resident, it's pretty standard. 35% down is kind of the starting point on the down payment, and then they should have some attachment to Canada in the sense that they have income and things like that. Now, it doesn't necessarily have to be in Canada, but we have to show that there is some income in order to make those payments. Excuse me. If they are buying for the purposes of rental, then we can add the rental income or projected rental income in as well. So there's that. Self-employed, it's really easy, just 2-year average. Whatever the 2-year average is for the person, we use that. And whether you're getting an insured mortgage through the default insurance or you're getting a conventional mortgage, the income is still calculated.
20%?
Pardon me?
How much down payment? 20%?
Well, they could, somebody could be self-employed, and if they have only 5% down, as long as the debt servicing works, then they would qualify as anybody else would under a mortgage. They just have a 2-year average for income. Same thing on when they have conventional, 20% down, 2-year average.
Sorry, there's a bit of a lag here in the video. I didn't mean to cut you off. Okay, so what's the longest amortization you could do now? So because that helps with the payments and stretching it out and debt servicing.
Yeah, well, if it's an insured mortgage, it's 25 years. If it's a non-insured conventional mortgage, 30 years.
30 years is the max now.
Yeah.
Okay, so we looked at self-employed and employed, just the standard 2 years.
Well, 2 years, not necessarily. 2 years would be as if they get variable components to their income, like if they have bonuses, then we get a 2-year average because that might push them up higher. We'll always try to get and use the maximum amount of income that we can do for qualification. However, for the most part, most salary employees, if they're government or different types of organizations like that, their income is their income. It's not going to change that much. So that's just a T4 in recent pay stubs. So it's very easy for somebody that's salary.
Okay, awesome. No, I'm just in shock at just like in a month how quickly this market has cooled down. At least on the real estate side, I have noticed people just waiting on the sidelines, really.
Yeah, and I think that's probably what kind of where we're at right now. It's going to be, a wait and see attitude, because a lot of it is, we have another rate announcement in September, and will they move again? And that will potentially move us up again. So that will then put more pressure on that. So, we might see more, people selling though, and trying to get out of it. However, unless you needed to sell, you might just say, I'll wait right? And if you can sustain the higher rate increase, or if you're already in a mortgage, then that's not really going to be an effect. It doesn't really impact you. Again, I guess if you don't have to sell, you probably won't, but we won't see as much movement as we did the last 2 years.
Okay, and then just to end the video soon and wrap up, what's the trend you're seeing with your buyers right now for mortgages? Like typically, what are you seeing? They're fixing in lower rates. What product are they mostly going for now that this whole rate has changed? So what is it? What are you finding more people are getting into?
That is an ongoing thing. I mean, the majority of people were kind of going variable before, and now that's kind of suddenly changed pretty quickly. And now people are maybe looking at shorter term rates of 2 or 3 years, just to kind of hedge. Because what we don't want to have happen is what happened in 2020, where rates did go up. Prime was 3.95, and a lot of people started locking in. They locked in at high threes, only to then have rates fall. And they were in these mortgages that would have then had major penalties on them. So same kind of thing as what we're at right now, is that while rates are kind of moving up, you don't necessarily want to go into a 5-year traditional type of, let's just take a 5-year, because if the rates do adjust back down slightly, you want to be able to kind of take advantage of that. Don't want to be locked in. So that's why maybe a 2 or 3 year rate is kind of just, and then again, if this is what the new normal is as far as rates, then that rate will be similar in 2 or 3 years anyways. So it's not really going to be that much different. So you kind of just keep moving it along and seeing where rates are going to go.
Awesome. Well, I think this was amazing. Thank you so much, Kevin. And I look forward to doing more videos where you can educate my buyers and my peeps on what's available out there, because it all comes down to money. Cheers. Take care.